Hi, welcome to this podcast where I'm very quickly going to look at the duties of directors and the contents of the directors' report. Okay, duties of directors, I'm going to focus very much on the financial duties here. I will cover some of the more general duties when I look at corporate governance. But in relation to the accounts, they're responsible for preparing the actual accounts, so that's the income statement, statement of financial position. They would also have to prepare a cash flow statement, and because these will be limited companies, statements of changes in equity. The accounting policies that are followed by a firm, so for example, what type of depreciation are they going to use, and either what rate of depreciation or the number of years, if they're doing straight line, they will apply to particular assets, and also follow both international accounting standards or international financial reporting standards, as it's increasingly changing over, national company law, and the requirements of any stock exchange if listed. When we sort of look at the requirements of stock exchange, for example, if you list on the London Stock Exchange now, you have to make sure that your accounts are available online to be viewed. One that they need to sort of do a balancing act on is preserving confidentiality of the information in the accounts while trying to ensure they're giving sufficient information to shareholders and increasingly all the stakeholders to make their decisions. And that's quite a tricky one, because obviously the first thing that happens when a company puts their accounts online, all the competition are going to look straight away at the information contained within those accounts. They need to make sure that all the information required is being collected. So it's not just from the main company, but if they've got branches and if they've got subsidiaries around the world, that accounting information also needs to be taken into account in the final accounts. They need to take account the interests of all stakeholders. So it's not just the shareholders, for example, employees, the local community, and the company's creditors need to be taken into account when the accounts are prepared. They need to meet the time requirements for reporting. So, for example, if you're listed on the London Stock Exchange now, then those accounts have to be available to the shareholders within 6 months of the end of the financial year. They need to take into account the costs of collecting information and compare to the usefulness of users. So, for example, if the company was expecting to lose a court action and it was only going to be £200 or £300 they were going to lose, or maybe in that case, paying a independent advisor to advise on the potential losses of the court action might not be a good use of company resources. And in that case, you'd probably just either put an estimate in, or you might just ignore it because it's going to be insignificant and will just appear as a very minor expense in the next year's accounts. And something that's often missed, but the directors are responsible for supporting all the auditing requirements. So that's things like giving access to the accounting system and also answering any questions the external auditors might have of the company. Okay, just a quick recap of the contents of the director's report, and then we will review how useful it is. Okay, it should contain a review of the principal activities of the company and also significant future developments. So things like, are they researching a new drug which is likely to be very, very profitable, and how close to finally releasing the drug are they? And that should include past and future significant events. So the significant events that have happened in the last 12 months and what's expected for next year, and significant changes in non-current assets. So, for example, if the company has 4 times the value of premises now that it had last year, why has that occurred? Has it occurred because of a revaluation of the assets, or have they, for some reason, gone out and bought a lot of new premises? Need to report on significant events occurring after the accounting period. So if the accounts finished on the 30th of April and there was a major fire, for example, in one of the main factories, that would need to be in the accounts because it will have a significant impact on what the stakeholders expect in the future. The names of directors and their interests should be disclosed somewhere in that, along with their remuneration as well. And that's what we mean by their interests are, have they got a significant shareholding in the business? Have they got share options in the business? And particularly non-executive directors, some of them may have an interest in either a supplier company or a customer company, and that should be disclosed. What the employee involvement within the business is, so things like work councils, but also how information is passed to employees and how do they consult and get information back from employees. Policies on disabled employees, health and safety policies and how that's enacted. And certainly in the UK, there are quite stringent requirements on what a company does with regards to health and safety, whether they make political or charitable donations. And again, if you're giving money, for example, to a political party, people should know that, because people might not agree with what they are doing and they might not want to invest in a company that's giving significant amounts of money to a political party. And something that's relatively new as well, creditor payment policy and how long they spend or take to pay their suppliers. And that's certainly in the UK, because there's been a lot of controversy about some big companies taking an awful long time to pay their suppliers. And in some cases, this has led to the suppliers going out of business. Eventually, the state of the director's report in its entirety, so not just the financial accounts, but the actual written bit. It gives stakeholders a lot more information that they need to make decisions about whether they want to be invested or working for a particular business, and that has to be good. It's auditable, and when the auditors come in, it's not just the financial part of the accounts now that they audit, but they do also audit what the directors write. It's very often required for stock market listings. In fact, it is required for stock market listings now. And it can also be attractive to investors, not just if the company has a good news story to tell about things like its profitability, but also ethical investing is something that's very, very much on the rise now. And if a company is acting ethically, it can attract a lot more investment into the business. And there's been a lot on the news recently about particularly younger shareholders, for example, refusing to invest for businesses in businesses that are harmful to the climate, but being very keen to invest in new energy technologies that they see as being the future. Disadvantages, well, first of all, if you go and read a company's accounts, it's very, very rare in the review of activities, for example, that the directors say that they are managing the business awfully. So the written parts are almost read like an advert for the company quite often, even though they are auditable. And also, companies have always window dressed the financial part of the accounts. For example, businesses I've worked for, there's a real drive, and the month before the accounts are due to be reduce the amount of trade receivables outstanding, and in that way you can drive down the trade receivable days. So it may be that it appears like the company is collecting money off their customers after 28 days, but that might only happen for a month of the year, and for a large part of the year that is a much longer period. There's definitely a criticism that they give too much information to the competition, and we already talked about one of the big problems for directors is trying to balance in giving enough information so that the stakeholders can make their decisions alongside that need for confidentiality and not giving away too much information to the competition. They're expensive. It takes up a lot of senior management time to write the directors' reports. And also there's a large distribution cost. They're always very, very glossy. they use expensive paper, they then get posted out to people, and the total of that can be quite a lot of money. Understandability. A lot of the information, particularly when you get to the detailed notes of a limited company, can be quite tricky for the man in the street to understand. And also, these things now are getting quite long. You can be looking at 140 pages for the total set of accounts. And are people getting too much information so that they can't sort out the key information they need to make decisions, rather than having to trawl through all the information, some of which is effectively just a PR stunt for the senior management saying how well they've done in particular areas, and that can lose people from focusing on the areas where the company perhaps isn't doing so well. For my students, I've attached a couple of questions to the slides that I'm going to share with them. And what I certainly expect you to do is to do those essays, please, and to send them back to me. Good luck. Thank you very much. Bye-bye.